Most people think the 2008 crisis ended when Congress passed a $700 billion bailout. But I was there, watching Lehman Brothers collapse after 158 years in business. I remember the exact morning AIG lost $99 billion in a single quarter and begged for rescue. That September alone, the Dow Jones fell over 2,700 points, its worst monthly drop since 1931. While CEOs slipped out golden parachutes worth hundreds of millions, ordinary families lost over $16 trillion in household wealth. Nearly 10 million Americans lost their homes. More than 8.8 million lost their jobs. If you think that was the end of the story, you're wrong. It was the beginning of an experiment that still hasn't stopped. Between 2008 and 2014, the Federal Reserve printed over $4.5 trillion through quantitative easing, money conjured from nothing, injected straight into Wall Street. And the dollar you carry today, it was quietly devalued to keep that game alive. I'm Nate Ledger. I've spent years tracing how that crisis paved the road to permanent bailouts, record deficits, and a dollar so diluted it's barely recognizable. Stay here, because by the end of this video, you'll understand why 2008 wasn't just a crash. It was the moment the American currency entered a decline that no politician can reverse. In the early 2000s, American neighborhoods glowed with optimism. For the first time in generations, families earning modest salaries were buying homes with granite countertops and two-car garages. But hidden behind the new mortgages was a system ready to implode. Subprime lending exploded after 2001, driven by an idea that almost sounded noble. Everyone deserved a house. Banks issued loans to people with shaky credit, layering teaser rates that would later skyrocket. One example is the infamous 2/28 adjustable rate mortgage, fixed for 2 years, then resetting to a much higher payment. By 2006, nearly 1 in 5 new mortgages were subprime, with over $600 billion issued in a single year. I remember reading an industry report that bragged about these loans as innovations, as if that label disguised the risk. The real motive wasn't fairness, it was the hunger for fees and commissions. Lenders packaged thousands of questionable loans into mortgage-backed securities, which were then sold to pension funds, insurers, and investors worldwide. These bundles earned AA ratings from agencies that had every reason to look the other way. It created a paradox: the riskier the borrower, the richer the bank's short-term profits. One mortgage broker later admitted he would approve loans for clients who had no income documentation at all. He called it the art of getting the deal done. If you can picture an entire economy building castles out of unsigned paperwork, you're already grasping why this collapse was inevitable. Around that same time, Wall Street started engineering collateralized debt obligations, CDOs, that layered subprime debt with higher-rated slices to create the illusion of safety. Some deals were so convoluted that even their creators couldn't fully explain them. Lehman Brothers alone held $85 billion in mortgage securities by 2007. A curiosity worth holding on to: while homeowners signed for adjustable rates, executives quietly exercised stock options worth tens of millions, locking in their personal gains before the resets began. As this mountain of leverage rose, the last line of defense, basic underwriting standards, simply disappeared. No regulator dared to pull the brakes because everyone from mortgage brokers to credit agencies was cashing in. Here's something few realize. By 2008, the combined value of outstanding U.S. mortgage debt reached nearly $10 trillion, a sum greater than the GDP of every country except America itself. When you see how that number dwarfed the safety nets supposedly in place, the next chapter begins to make chilling sense. In the summer of 2007, the first crack split wide open. 2 hedge funds run by Bear Stearns imploded under the weight of mortgage securities everyone insisted were safe. Those funds held nearly $20 billion in assets on paper. In reality, many of their bonds couldn't be sold at any price. I remember that week vividly. It was the first time I saw traders whisper that the system might be unraveling. A rumor spread that if Bear Stearns couldn't survive, no one was safe. Soon, investment banks started hoarding cash, refusing to lend to each other. The interbank lending rate, known as LIBOR, surged past 5.5%, signaling deep fear beneath the surface. While the public carried on, a few contrarian investors were quietly betting the whole system would fail. One was Dr. Michael Burry, a California neurologist turned hedge fund manager. He spent months reading through thousands of mortgage documents by hand. Burry realized that the default rates on subprime loans were already spiking, and the adjustable rate resets hadn't even peaked yet. In 2005, he began buying credit default swaps against the housing market, effectively purchasing insurance on billions in bonds. By the time the crisis hit, Burry's firm had earned over $700 million, while the institutions on the other side of his trade suffered catastrophic losses. This was the foundation of what would later be called the Big Short. I always tell viewers this. Sometimes the most dangerous risk is the one no one wants to see. Lehman Brothers was the largest underwriter of mortgage-backed securities in America. When it finally collapsed in September 2008, it held over $600 billion in assets and more than $30 billion in subprime exposure. I watched live coverage as Lehman employees carried boxes of personal belongings onto 7th Avenue. After 158 years in business, it was over in a weekend. That single bankruptcy remains the largest in U.S. history. It triggered a cascade. Credit markets froze, stock indexes collapsed, and household wealth vanished almost overnight. A detail many forget: on September 29, 2008, the Dow Jones Industrial Average plunged 777 points, wiping out over $1.2 trillion in market value in a single session, and this was just the opening act. When Lehman Brothers collapsed, the government faced a choice: let more banks fail or step in with unprecedented force. By October 2008, Treasury Secretary Henry Paulson stood before Congress demanding emergency powers. He warned that, if nothing was done, the entire financial system could disintegrate within days. The requested sum was staggering: $700 billion, the largest rescue package in U.S. history. I remember watching that live broadcast from my apartment, stunned at how quickly everything that once felt unshakable turned to desperation. The Troubled Asset Relief Program, TARP, passed on October 3, 2008. But here's what most people never learned: those funds were only the beginning. Over the next 2 years, the Federal Reserve quietly pumped trillions more into the system. According to audit reports later released under pressure, the total commitment reached $16 trillion spread across direct loans, liquidity facilities, and guarantees. Even foreign banks received emergency funding, including Barclays, Deutsche Bank, and the Royal Bank of Scotland. The Federal Reserve's balance sheet ballooned from $870 billion in 2007 to more than $2.2 trillion by late 2009. Chairman Ben Bernanke defended these interventions, arguing they were essential to prevent total collapse. But I've always believed the story isn't that simple, because every dollar created out of thin air diluted the purchasing power of the ones you already owned. One striking example was the AIG bailout. The insurance giant had underwritten over $500 billion in credit default swaps on mortgage-backed securities. When AIG couldn't pay, taxpayers became the counterparty of last resort. In a single quarter, the company posted a $99 billion loss, the biggest in corporate history. AIG ultimately received $182 billion in federal support. Yet in March 2009, as families faced foreclosure and unemployment, AIG executives awarded themselves $165 million in bonuses. It was the moment public outrage exploded. I still remember seeing a protester sign outside AIG headquarters and, "They get bailed out, we get sold out." If you think the damage ended with TARP, you're in for a shock. Once the bailouts were in motion, the Federal Reserve took another radical step: quantitative easing. It sounds like harmless jargon, but I want you to picture it the way I did back then: a controlled detonation that rewrote the rules of modern finance. In November 2008, the Fed announced QE1, a plan to purchase $600 billion in mortgage-backed securities to stabilize the housing market. This was just the first salvo. By June 2010, the total expanded to $1.25 trillion in mortgage bonds and $300 billion in Treasury securities. I spent weeks studying the balance sheets during this period. Before the crisis, the Fed's total assets hovered under $900 billion. By 2015, after 3 rounds of QE, that figure topped $4.5 trillion, a 5-fold increase in less than a decade. One trader I interviewed in 2012 described QE as money steroids. He said it propped up asset prices, but left ordinary savers earning less than 0.1% on deposits. And he was right. interest rates plummeted to near zero, pushing investors into stocks, real estate, and riskier bets in search of yield. A curiosity worth remembering, the S&P 500 more than doubled between 2009 and 2013, even as unemployment remained stubbornly high. That disconnect wasn't accidental, it was engineered. Chairman Bernanke defended QE by claiming it created a wealth effect, where rising asset values would eventually lift the broader economy. But the reality was far less democratic. According to a 2014 study by the Federal Reserve itself, the top 10% of households captured more than 70% of the gains. Meanwhile, wage growth for the bottom half barely budged, and while QE was hailed as a miracle solution, it came with invisible costs. From 2009 to 2019, the dollar lost nearly 18% of its purchasing power. Groceries, rent, and healthcare climbed steadily while official inflation numbers downplayed the impact. The paradox still stuns me. A policy designed to rescue Main Street ended up enriching Wall Street first. When I first started studying the aftermath of the crisis, I kept asking the same question. If trillions were created out of thin air, where did all that value go? The truth is, it seeped into everything you buy, from a loaf of bread to a college degree. Between 2008 and 2020, the Federal Reserve's balance sheet grew from $870 billion to over $7 trillion. That surge wasn't just an accounting curiosity. It was the spark behind the most aggressive monetary expansion in modern U.S. history. Consider the Consumer Price Index. In 2009, the average price of a dozen eggs was $1.66. By 2021, it had climbed past $2.80, even before the COVID-19 supply shocks. And housing? Median. Home prices rose from around $180,000 in 2009 to over $300,000 a decade later, a 66% jump. I still remember a conversation I had with an elderly couple in 2015. They'd saved for decades, expecting their nest egg to carry them comfortably. Instead, their savings earned less than 1%, while rent and healthcare climbed every year. Their story wasn't rare, it was the norm. This silent debasement wasn't accidental. When the Fed prints money to buy assets, it inflates the value of those assets first. Stocks soar, bonds rally, but wages lag, and essentials grow steadily more expensive. The process is so gradual that many people never connect the dots. According to the Bureau of Labor Statistics, between 2009 and 2019, average hourly earnings rose 28%. But rents in major cities climbed 40% or more over the same period. The purchasing power of every paycheck quietly slipped away. A 2019 Gallup poll found that 58% of Americans believed their incomes were not keeping up with the cost of living, a direct consequence of policies sold as economic rescue. Sometimes I think about how the dollar was once defined in the Coinage Act of 1792. 371.25 grains of pure silver. Today it's nothing more than a promise, a digital IOU backed by confidence alone. The story doesn't end here. When people ask me why I keep researching this story, I tell them it's because the crisis never really ended. It only changed shape. And every statistic I uncover suggests the foundation beneath the dollar is weaker than ever. By the start of 2020, America's national debt had climbed past $23 trillion, nearly double what it was before the financial crisis. If you break that number down, it works out to more than $70,000 per citizen. And the debt ceiling, which was once a hard limit, has become more like a ceremonial line everyone pretends not to notice. During the pandemic response, the Federal Reserve launched a fresh wave of asset purchases so vast it eclipsed even the 2008 rescue. Between March 2020 and December 2021, the balance sheet expanded by over $4.6 trillion, ultimately surpassing $8.7 trillion. That's almost 10 times the size it was before Lehman Brothers failed. I want you to consider a detail that rarely makes headlines. By late 2021, the Federal Reserve was buying $120 billion in Treasury's mortgage-backed securities every single month. That meant the government could run trillion-dollar deficits without worrying who would buy the debt. The central bank had become the market itself. If you think this arrangement can last forever, history suggests otherwise. In Griffin's The Creature from Jekyll Island, he argued that fiat currency systems always end the same way, a crisis of confidence. Once people begin to suspect that printed money has no anchor, the rush for real assets begins. In the final months of 2021, inflation surged to levels unseen in 4 decades. Consumer prices rose 7% over the year, while used car prices spiked 37%, and energy costs jumped 29%. Officials called it transitory. But by 2022, even the most cautious economists admitted the purchasing power of the dollar had eroded far faster than predicted. I remember a moment in early 2022 when I looked at the data and thought, this is the legacy of 2008. The bailouts, the stimulus, the quantitative easing, it was all part of a trajectory that made the dollar more vulnerable, not less. And here's the irony most will never see. The very policies designed to rescue the system have left it addicted to ever larger injections of debt and money creation. I'm Nate Ledger. And if you followed this story to the end, you already understand something most people never will. The next crisis won't be a surprise. It will be the inevitable consequence of a system built on borrowed time. If you're still here, you're the kind of mind this channel was built for. Subscribe, because next time we follow the money, literally, I'll break down how the US dollar became tied to oil, war, and global control. It's the petrodollar story. They hope you never trace back to your own wallet.